War in the Middle East, here is what happens to your TSP next. This is not a normal week. Over the last several days, the United States and Israel launched major military strikes against Iran. Iran's supreme leader was killed in the opening operations. Iran responded immediately, launching missile barrages across the region and targeting U.S. and Israeli military installations in several Gulf countries. And then Iran did something it has been threatening to do for years. It moved to close the Strait of Hormuz. The IRGC, Iran's Revolutionary Guard, broadcast warnings over marine radio instructing vessels not to pass through the strait. Major shipping companies and their insurers responded immediately. Tanker traffic through the strait has dropped roughly 70%. Oil majors and trading houses have suspended crude oil and LNG shipments through the corridor. Oil prices surged more than 8% when markets opened Monday. Brent crude briefly touched $80 per barrel. Analysts at JP Morgan are warning it could hit 120. Societe Generale puts the extreme case at 150. And I know exactly what is going through your mind right now if you are a federal employee watching this. You are not thinking about geopolitical strategy. You are not thinking about missile trajectories. You are thinking about your TSP. Should I move to the G fund? Should I change my allocation? Should I do something? Should I do nothing? What is actually happening to my retirement account right now? Today we are going to answer all of those questions. Calmly, specifically, and with real data from what is happening in markets right now. No hype, no panic, just strategy. Here is what we are going to cover. Why the Strait of Hormuz matters so much that its disruption moves global markets within hours. What history actually tells us about how stocks behave during military conflicts and geopolitical shocks. How an oil shock ripples through the economy and lands in your specific TSP funds. And what disciplined long-term investors actually do in moments exactly like this one. Let's get into it. Why the Strait of Hormuz changes everything. To understand what is happening to markets right now, you have to understand exactly what the Strait of Hormuz is and why its disruption is categorically different from other geopolitical events. The strait is a narrow shipping corridor sitting between Iran to the north and Oman and the UAE to the south. At its narrowest point, it is about 33 kilometers wide, less than 21 miles. And inside that sliver of ocean, the entire energy export infrastructure of the Persian Gulf depends on two designated shipping lanes, each about 3 kilometers wide, moving in opposite directions. Think about what passes through those lanes every single day. Roughly 20 million barrels of oil and petroleum products. That is approximately 20% of global daily oil consumption. It represents nearly 30% of global seaborne crude trade. About 3,000 vessels transit the strait every month. Saudi Arabia, Iraq, Kuwait, the UAE, Qatar, all of them depend on this corridor to export energy to the world, and there is no backup plan for most of them. Onshore pipeline capacity for the region is limited to roughly 3 million barrels per day. That is a fraction of what moves through the strait. And it gets more specific than oil. Qatar is the second largest exporter of liquefied natural gas in the world. Nearly all of Qatar's LNG exports move through the Strait of Hormuz. Japan, South Korea, and large parts of Europe depend on that gas to heat homes, generate electricity, and run factories. There is no pipeline alternative for LNG. It must move by ship through this corridor. Iran's geographic leverage is real. Here is why Iran's threat carries weight that most other geopolitical threats do not. The shipping lanes at the narrowest point of the strait fall within the territorial waters of Iran and Oman. Iran has geographic leverage that is not hypothetical. Iran's arsenal for disrupting traffic includes naval mines deployed by fast attack boats, anti-ship missiles, surface vessels, semi-submersible craft, and submarines designed for asymmetric warfare. Iran does not need to formally blockade the strait to effectively close it. It demonstrated this week that selective drone and rocket attacks on tankers are enough to cause shipping companies and their insurers to balk entirely. War risk insurance premiums have surged. That is what has effectively halted traffic, not a formal naval blockade. Iran's parliament passed a motion last year authorizing the closure of the strait. The Revolutionary Guard commander this week explicitly confirmed the strait was closed and that any ship attempting to pass would be set on fire. Why markets react before confirmation? One of the things that surprises people when they watch financial markets respond to geopolitical events is the speed. Oil jumped more than 8% at the Monday open. European equity futures were already down before U.S. markets opened. Gold was rising Sunday night. Here is why markets move so fast. Professional traders and institutions are not waiting for official confirmation of anything. They are pricing in probability distributions of outcomes. When the probability of a sustained oil supply disruption goes from near zero to meaningfully positive in a matter of hours, every asset that is sensitive to oil prices reprices simultaneously. And oil is sensitive to this particular shock because of what analysts call a dual supply shock. It is not only that current exports through the strait are halted, it is also that OPEC's spare capacity, which is normally the global market's safety valve when supply disruptions happen elsewhere, is inaccessible while the waterway remains closed. The additional production that OPEC countries announced they would bring online is stranded behind the same bottleneck. That is why analysts are talking about $120. That is not hype. That is the math of what happens when 20% of global oil supply loses its only exit route and there is no readily available replacement. What history actually tells us about markets and conflict. One of the most common mistakes investors make during geopolitical events is assuming that the market response will be either much worse or much better than history suggests. So let's actually look at what history says, because it is instructive here, and it does not tell a simple story. The consistent pattern is that markets hate uncertainty more than bad news. If you study geopolitical shocks and market reactions across the last several decades, a consistent pattern emerges. Markets typically sell off sharply on uncertainty before or during the initial shock, and then, once the situation becomes clearer, even if the news is bad, markets often stabilize and begin recovering. The Gulf War in 1991 is a clean example. Markets dropped on the uncertainty leading into the conflict. Once the war began, and it became clear the engagement would be swift and decisive, stocks rebounded relatively quickly. The resolution of uncertainty was a catalyst for recovery, even though a war was actively underway. The Iraq War in 2003 followed a similar pattern. Pre-war volatility, sell-off, then stabilization and recovery once the initial uncertainty resolved. The Russia-Ukraine invasion in 2022 shows the same shape: sharp initial sell-off, gradual adaptation, and market recovery as investors priced in the new reality, and most directly relevant to right now. When Israel struck Iran's nuclear facilities in June of 2025, equity markets sold off sharply at the open, then recovered the same day once it became clear the Strait of Hormuz had not been disrupted. That single-day bounce is the template traders are actively referencing right now as they assess this week's situation. The exception to this is that duration is everything. But here is where I have to be honest with you, because intellectual honesty is more useful to you than false reassurance. The reason markets recovered quickly in 2025 when Israel struck Iran's nuclear sites was specifically because the strait stayed open. The reason the pattern works in most historical conflicts is because oil supply was not materially disrupted for an extended period. This situation is different in one specific way. The strait is effectively closed right now. Tanker traffic has dropped 70%. That has not happened in the post-war era, not in 1991, not in 2003, not in 2022, not even in 2025. What history tells us is this: short, contained geopolitical shocks that do not materially disrupt global energy supply for extended periods produce temporary volatility and recoveries. The key variable is whether the supply disruption is real and sustained. What distinguishes this moment from most historical precedents is that we are already in early scenario B or early scenario C territory in terms of actual supply disruption. The question that will determine whether this looks like 2025 or something more serious is how quickly tanker traffic resumes, whether the U.S. Navy can and will escort ships through, and whether diplomatic channels open fast enough to de-escalate before the market's patience runs out. What the long-term charts always shows. Now here is the part that is genuinely reassuring, and I want you to hold it in tension with everything else I just said. If you pull up a long-term chart of the S&P 500 and mark every geopolitical shock since 1950, you will notice something. Every single one of them, including the ones that felt catastrophic in the moment, including the oil embargo of 1973, including the Gulf War, including 9/11, including 2008, including 2020, appears on that chart as a temporary dip in a long upward trajectory. Markets are ultimately driven by corporate earnings, by innovation, by human productivity, and by economic growth. Geopolitical shocks disrupt those forces temporarily. They have never permanently derailed them. For a federal employee with 15, 20, or 25 years until retirement, that long-term chart is your operating environment, not this week's oil price, not this weekend's headlines, but that does not mean you should not understand what is happening in the short term, because understanding it is what allows you to make calm, informed decisions instead of emotional ones. Let's talk about how an oil shock ripples into your TSP funds. Let me walk you through exactly how an oil shock at this magnitude works its way through the global economy and lands in your specific TSP funds. Because the transmission mechanism matters. It is not just oil goes up, stocks go down. It is much more nuanced than that. Think about the transmission mechanism. Oil price spikes hit the economy through several channels simultaneously. The consumer channel, when oil rises, gasoline prices follow within days. Average retail gas prices could rise 10 to 30 cents per gallon in the near term based on current analyst estimates, with some stations seeing jumps of 85 cents or more. That is money directly out of household budgets. The business cost channel, higher transportation costs, higher energy costs, higher raw material costs. Airlines, manufacturers, logistics companies, food producers, retailers, all of them face margin compression when oil stays elevated. The inflation expectation channel, when consumers and businesses start expecting prices to keep rising because energy is expensive, they behave differently. Workers demand higher wages. Companies raise prices preemptively. The inflation dynamic becomes self-reinforcing. The monetary policy channel, this is the one that matters most for your TSP right now. The Federal Reserve was expected to cut interest rates in 2026. Markets were pricing in those cuts. Rate cuts are fuel for equities. They reduce the discount rate applied to future earnings and make stocks more attractive relative to bonds. An oil shock that keeps inflation elevated could remove those cuts from the table entirely. And when the rate cut narrative dies, equity valuations come under pressure. Now let's go fund by fund. The C fund tracks the S&P 500. It is the core of most federal employees' TSP allocation and where the most money sits. In an oil shock environment, the C fund faces three simultaneous forces pulling in different directions. On the positive side, energy companies make up roughly 4 to 5% of the S&P 500. When oil spikes, Exxon, Chevron, ConocoPhillips, and the broader energy sector surge. That is a genuine partial cushion for the index. It does not fully protect it, but it blunts some of the downside. On the negative side, higher oil costs compress margins across airlines, manufacturers, retailers, shipping companies, and consumer goods firms. Their earnings guidance gets cut, and markets reprice stocks based on lower expected future earnings. The third force is the Fed variable. Equity valuations have been supported this year by the expectation that the Fed would cut rates. An oil shock that keeps inflation elevated could kill that narrative. When rate cut expectations disappear, the valuation math for equities changes materially. What does this look like historically? Oil shocks that do not tip the economy into recession typically produce mid-single-digit corrections in the S&P, something in the range of 5 to 8% from the peak. Painful but recoverable, especially for long-term accumulators. Oil shocks that do trigger recessions produce corrections in the 15 to 25% range or deeper. The June 2025 precedent is directly relevant here. Sharp open, same-day recovery once the Strait stayed open. That pattern holds if disruption proves temporary. The pattern breaks if disruption proves sustained. The S fund tracks small and mid-sized U.S. companies, and in an oil shock, small caps face a compounded version of the same pressures that hit large caps with less cushion on every front. Small companies have thinner margins and less pricing power. They cannot absorb rising input costs the way a large multinational can. They carry more debt relative to their size in many cases, often at floating rates. If the oil shock delays Fed rate cuts or revives fears of rate increases, small companies' debt burdens get heavier in real terms. Small caps are also more purely exposed to domestic economic conditions. When U.S. consumers start spending more on energy and less on discretionary items, smaller businesses feel that contraction faster and more deeply than large multinationals with diversified global revenue streams. In market terms, the S fund has higher beta. It amplifies the moves of the broader market in both directions. If the C fund drops 5%, the S fund might drop 7 or 8. If the C fund drops 15% in a recession scenario, the S fund could be down 20 to 25. The important counterpoint, the S fund also bounces harder and faster when recovery comes. For investors with long-time horizons who are still accumulating, S fund volatility during an oil shock is a behavioral test, not a financial disaster. The ability to continue contributing through that volatility is a structural advantage. The I fund tracks international developed market stocks, primarily Europe, Japan, and other developed economies outside the United States. And here's the honest assessment. In a sustained oil shock of this magnitude, the I fund faces the deepest and most prolonged exposure of any equity fund in the TSP lineup. The United States has become a significant energy producer over the past decade. The shale revolution changed the country's position. When oil prices spike, the U.S. economy is not purely a victim. It is partly a beneficiary through its energy sector. Europe is not in that position. European nations are substantial energy importers, German manufacturers, French consumers, Southern European economies, all of them depend heavily on imported oil and gas. And European natural gas stockpiles are currently depleted, which means the energy cost shock hits European industry and households with less of a buffer than usual. We are already seeing this reflected in early market data. Euro Stoxx 50 futures dropped more than 1%. DAX futures, which track the German industrial economy, dropped even more. The UAE and Kuwait temporarily closed their stock markets entirely, citing exceptional circumstances. There is also the currency layer that hurts iFund investors specifically. In a risk-off environment, the US dollar strengthens as investors globally seek the safety of dollar-denominated assets. For a US investor holding international stocks, a stronger dollar is a direct headwind. Foreign stock gains in local currency terms get converted back into fewer dollars. That creates a double hit: weaker underlying markets and unfavorable currency conversion. The F Fund tracks a broad US investment grade bond index, and its reaction to an oil shock is the most nuanced of any fund we are discussing today, because it depends entirely on which narrative markets are running with. If inflation fear is dominating, as it typically does in the early weeks of an oil shock, bond yields rise because investors expect the Fed to stay restrictive or tighten further. When yields rise, bond prices fall. The F Fund loses value. If recession fear is dominating, as it often does in the later stages of a sustained oil shock, investors flee into treasury bonds as a safe haven, yields fall, and bond prices rise. The F Fund benefits. The practical implication: in the early weeks of this situation, the F Fund faces headwinds. If the shock persists for months and recession fears build, the F Fund becomes a reasonable defensive allocation. But the timing of that shift is genuinely difficult to call. The F Fund is not a simple safe haven during oil shocks. It is context dependent. Watch whether the narrative in bond markets is running on inflation fear or recession fear. That tells you which direction the F Fund is headed. The G Fund holds U.S. government securities. Its value does not decline with market volatility. It earns a steady return. During any period of market stress, it is the most psychologically attractive option in the TSP lineup. And I want to talk about the G Fund carefully, because it is not about whether the G Fund is good or bad. It is about when it is appropriate and when the instinct to move into it is actually working against you. The G Fund is genuinely appropriate as a ballast for your overall portfolio. If you are within 5 to 7 years of retirement, having a meaningful G Fund allocation is not fear-based. It is sound retirement positioning that should have been in place already. The behavioral trap with the G Fund appears when investors use it as an escape hatch after volatility has already started. Moving to G after markets have already dropped 5 or 10% does two things simultaneously. It locks in the paper loss as a real loss, and it removes you from the recovery when it comes, which historically comes faster than scared investors expect. The question to honestly ask yourself right now is not whether you are scared. The question is whether your current TSP allocation actually matches your time horizon and retirement goals. If your allocation was already appropriate for your situation before this weekend, the correct response to volatility is almost certainly to hold it. If your allocation was already too aggressive for your actual situation, the correction needed to happen regardless of what is going on in the Middle East. What are the biggest mistake investors make in moments like this? I want to spend some real time on this section because it is where the most long-term financial damage happens, not in the market itself, in investor behavior during the market. The sequence that destroys wealth? Here's the sequence I have seen play out repeatedly across multiple geopolitical shocks and market downturns. Friday, markets close. Big geopolitical news breaks over the weekend. Investor spends Saturday and Sunday reading scary headlines. Monday morning, markets open down sharply. Investor logs into their TSP account, sees the balance is down several $1,000s, maybe tens of thousands of dollars depending on account size. The emotional response kicks in. This feels different this time. This one might not recover. I need to protect what I have. Moves everything or most of the allocation to the G Fund. 2 weeks later, the situation either de-escalates or markets simply exhaust the selling and bounce. The S&P recovers 2, 3, 4% in a week. The investor, now in the G Fund, watches the recovery happen without participating in it. Months later, markets are back near or above the pre-shock levels. The investor, still in the G Fund because re-entry feels scary too, has permanently locked in the loss and missed the recovery entirely. This is not a hypothetical. This is documented investor behavior across decades of market research. It has a name. It is called performance chasing, or in this case, loss aversion-driven market timing. And the academic literature on it is unambiguous. Investors who try to time markets based on news events consistently underperform investors who maintain their allocation through volatility. Why timing is so hard? Timing the market requires being right twice. You have to know when to get out, and you have to know when to get back in. Most investors who successfully call the exit miss the re-entry entirely, because getting back in feels just as scary as the original event. The headlines are still bad, the uncertainty is still there, so they wait, and the market continues to recover without them. You have 2 interfund transfers per month in your TSP. That is it, 2 moves. If you use one of them to move to G during a panic, you have one left for the month. And if the market recovers faster than expected, you may not have the mental bandwidth to make the re-entry move before the window closes. The structure of the TSP with its limited IFTs actually protects investors from themselves if they understand the design. It is built for long-term, disciplined allocation, not for active market timing. What the research says about staying the course: investors who maintained their stock allocations through the 2008 to 2009 financial crisis recovered fully within 3 to 4 years, and then significantly outperformed investors who moved to safer assets during the decline. Investors who stayed invested through the March 2020 COVID crash, which was one of the fastest 30% declines in market history, recovered their entire loss within 5 months. Investors who moved to safety during that decline locked in losses and watched a historically fast recovery happen without them. Investors who panicked during the 2022 rate hike environment and moved out of stocks missed the 2023 recovery, which was one of the strongest single-year equity returns in recent memory. The pattern is consistent. Market timing driven by fear produces worse outcomes than disciplined, long-term allocation. Every time. That does not mean holding through all volatility is painless. It means the pain of holding is almost always smaller than the cost of mistimed moves. The smart approach: scenarios, signals, and discipline. So what do you actually do right now? Let me give you a specific, structured approach. Step 1. Do not make any TSP moves this weekend. The worst time to make a financial decision is when you are emotionally activated by a news cycle. This weekend qualifies as exactly that. If you are watching this on Saturday or Sunday, do not touch your TSP. Let the dust settle. Let markets open Monday. Let the initial reaction play out. Decisions made in the middle of a fear response are almost always regretted. The data you have today is incomplete. The situation is still developing. Wait for more information before acting. Step 2. Know your scenario triggers. Here is a concrete framework for interpreting what happens next. Watch 3 variables: oil price direction by end of next week, whether tanker traffic through the Strait resumes meaningfully, and whether the US and Iran have any diplomatic contact. If oil is back below 90 by end of next week and tanker traffic shows signs of resuming, you are tracking toward what I would call Scenario A. A temporary spike. Markets will recover. Hold your allocation. Keep contributing. Do not touch your IFTs. If oil is still above 100 to 110 by end of next week, combat operations are still ongoing, and there is no diplomatic progress, you are tracking toward Scenario B, prolonged tension. Markets will be choppy for months. This is a moment to review whether your allocation genuinely matches your time horizon and risk tolerance. If it does, hold it. If you were overexposed to small caps or international equities relative to where you should actually be for your situation, a thoughtful rebalance toward your target is appropriate, not a panic move, a calibration. If oil pushes above 115 and tanker traffic through the Strait has not materially resumed after 2 to 3 weeks, you are in Scenario C territory. Now, a meaningful defensive adjustment is warranted for investors who are within 5 to 7 years of retirement or who genuinely cannot tolerate deeper drawdowns. A real move toward G-Fund as a ballast is appropriate in this scenario, but it should be a planned, deliberate allocation adjustment, not a panic exit. Step 3. Keep contributing, no matter what. Whatever you decide about your allocation, do not stop your TSP contributions. Not now, not ever during a market decline. This is the most consistently wealth-building action available to you. When you contribute to the TSP during a drawdown, you are buying shares at lower prices. Those shares compound for decades. Contributions made during the 2020 COVID crash at market lows produced some of the highest returns in TSP history over the following 3 to 4 years. That is the math of dollar cost averaging working in your favor. Stopping contributions during market stress is the equivalent of refusing to buy your favorite product when it goes on sale. The long-term accumulator's job during a downturn is to stay consistent and, if anything, find ways to contribute more. Step 4. Remember your full financial picture. Here's the part of the conversation that tends to get lost when market fear takes over. As a federal employee, your retirement picture is not just your TSP. Your federal pension is a defined benefit. It pays a predictable, inflation-adjusted income for the rest of your life. It does not go down because oil spiked. It does not lose 20% because markets corrected. It is structurally insulated from everything happening in markets right now. That pension is the equivalent of a bond in your overall financial portfolio, a large, guaranteed, inflation-adjusted bond. When you account for the present value of your pension, most federal employees are already more conservatively positioned than they realize. Their TSP equity exposure, even if it is 100% in CNS funds, is balanced by the pension's bond-like characteristics. That context matters enormously when you are looking at a TSP balance that has dropped this week. Your retirement is not only that number, your retirement is that number plus the present value of a pension that continues regardless of what markets do. Geopolitical events will always create uncertainty, headlines will always generate fear, and there will always be moments like this one where the temptation to do something, to take action, to protect what you have built will feel overwhelming. The investors who come out ahead in moments like this are not the ones who reacted the fastest. They are the ones who understood the framework, watched the right signals, and made decisions based on their actual situation rather than the news cycle. Here's what I want you to take away from today. Watch the 3 variables: oil price trajectory, tanker traffic through the strait, diplomatic signals. Those tell you which scenario you are in. Match your response to your actual time horizon and risk tolerance, not to your current fear level. Keep contributing, always, but especially now, and remember the full picture: a pension that pays for life, a system built for decades, a long-term chart that has absorbed every geopolitical shock in modern history and continued its upward trajectory. Volatility is the price of admission for long-term wealth, and federal employees who understand that are already ahead of most investors in the country. If this breakdown was useful, subscribe to Rod, The Art of Finance. Because on this channel, we give federal employees the framework to understand what is happening in markets, what it means for their retirement, and what smart, disciplined investors actually do about it. I will see you in the next one.